Hello viewers and welcome. I reckon if you've tuned into this video you're pretty serious about your trading, but I suggest before getting started into the nitty-gritty of this video, go grab yourself a coffee, cup of tea, packet of biscuits, definitely a notepad because there's a lot of information for you to take in this one, and then come back, press play, and we are ready to go. What's it all about? It's my 7-step process, my guide, my roadmap to building a successful systematic trading system or strategy. I've been doing it for 30 years for investment banks, hedge funds, trading companies. I hope pretty well, and in that I've learned a lot, and hopefully I can share that with you guys now. There's many advantages to becoming more systematic. Even if you don't go down the full technological route, it can help you trading psychology around consistency, discipline, process. But this video is all about, like I say, the roadmap. You've got to start somewhere. This is where to start from. You've got to plan out your systematic trading strategy, and I've boiled it down to a 7-step process, which, like I said, you can take away and then overlay into your world of trading, and hopefully you can go away then and build yourself a really great systematic trading system. So with that, let's get started. So the question is, what are we going to cover in this video? Well, the obvious one is where to actually start from your idea to reality. Then we are going to look at planning and building the trading system, testing the trading system, and then going live and living with that system. Let's start first with the pictorial overview of what we're really going to cover here, my 7-step process. Up the top, we start with the right mindset and skills. Got to have those before even thinking about moving on. Then I've got this bundle called the mental model, and inside that it's about having the idea, planning, building the system, testing it, and then making it better for the future. And you can do that using technical analysis, abbreviated there TA, quantification, back testing, future proofing, as I like to call it. And then you get some results, and then you go live. And in that going live phase, you've got 2 parts. You've got the incubation phase, the first time you're pressing the go live button, and then we're measuring our performance, always improving ourselves and our model, and that is sort of hits a loop then of constant improvement, adjustment, development, so you always maintain your trading edge. So to me, this is one of the most important steps, and it's often overlooked by traders. They just want to jump straight into building a great system. It doesn't matter, if you've got the PhD from the best, Parisian mathematical university. If you're a gambler, you're too risk averse, you're going to fail if you can't or haven't got the right mindset. You've got to start thinking differently. You've got to be more objective rather than subjective. That key word, systematic. You've got to start being disciplined, organized, thorough, methodical, consistent, analytical, measured, and a key word for me there is smart thinking. It's like being an entrepreneur, running your own business, thinking outside the box, coming up with ideas, solutions, but under this umbrella of a systematicness that provides a certain process for your trading. You've got to be, as it says there, quite robotic and business-like. It's always important to have role models, and in the picture there you see 2 guys that combined would make a fabulous trader today. You've got Q up the front, the computer data science geek, and then you've got James Bond in the back there with market experience, the smart thinker, that guy that thinks outside the box to get solutions done. Put all that together, you've got a fantastic trader, one that I think is going to be the way forward for trading over the next decade or so, and that's what I believe makes the great systematic trader. You don't need those skills at the moment, but bear them in mind. They're what you want to be moving to. Those disciplines, data science, computer science, getting a feel of how the market works. And like I said earlier, that entrepreneurial smart thinking mindset. So once you're confident you got step one sorted, you've got you're in the right headspace to be a systematic trader, where do you actually start this whole process? Well, it's going to come about really by having an idea. And it doesn't matter where that idea comes from. That's where the smart thinking comes into play. You might have some experience in a certain industry or market, profession that you can see that can turn into a trading process. Brainstorm, get those ideas down on paper, and then action those ideas into a formulaic process. And that process I call the mental model. What specifically is the mental model? Well, visualize it as a business document. If you go to your bank manager for a business loan, you take him a business plan, with all the facts, figures, details, ideas, concepts all in there. It's going to answer the who, what, where, why, how questions, and it's going to lay out the basics of your strategies, the rules, for example, markets, timeframes, entry, exit, trade management, expected returns, how are you going to run and maintain the strategy, and most importantly, what exactly is your edge in the first place. For those of you who are not sure what the edge exactly is, well, I've got it there for you. It's the mathematical advantage you have over any game that you play over time. In this case, it's all about trading, and this advantage should result in an assured percentage return to you over time. I like that word, over time, because a lot of people are very short-sighted in their trading, think they can do it for a couple of weeks and become millionaires. It's a longer term game than that, and it's over time. So the mental model is that supporting document that stays with you and holds you accountable for your actions during your strategy, lifetime and evolution. So tip for you here, like I said previously, think of it like a business plan. That bank manager presentation, seeking investment into an idea. Why should they buy into it? Don't shortcut this stage. You're only cheating yourself. Another way to think of the mental model, well, if you're a coder, if you could write down all that code to make the perfect program, you're going to put the detail in there to make it work and come out with the result you want. So that's one way of thinking about it. If you're not a coder, think of it like a user manual, a set of instructions to complete a complex task that if you just handed it over to someone, they could go away and run it all by themselves without ever speaking to you again. And don't forget these little two beauties. Smart, keep it smart, specific, measurable, achievable, realistic. That's a big one. You might write a bit of code that you think you can get 3,000–4,000% return. Is it something wrong there in the code? Is that really realistic for that market? Can you do that trade size, etc., etc., and also make it time bound? And then, I've seen over 30 years that the best strategies, systems, are the most simple. Keep it simple, stupid, as it says there. You follow that, break it down to its bare bones, and if you can get results out of that, then you should be successful. So in this video, I'm going to focus heavily on technical analysis, abbreviated there for TA, because that's my bread and butter, a big part of my background. But using TA does create many advantages around building a systematic trading system. Now today, pretty much everyone get their hands on some very decent software for technical analysis, so there's no excuses there really. But what are the advantages using TA for systematic trading? Well, it can make things much more objective, rule based, creates discipline. It's great for creating that systematic approach. Data is far more easily available. Well, this is an important point here. Don't think of it just as price data that you can put into technical analysis. Find data from other sources. If it can be turned into a data set, then you can turn it into technical analysis, and you can get some great insights into how markets or products or companies work by overlaying different data, fundamental data, for example, that you could turn into a data set these days. And then smart thinking, you can look at these charts, it can help you see, visualize ideas a lot more easily that you could only really do through technical analysis. So here's a couple of examples of sort of a non-traditional approach that hopefully can give you some inspiration that I've actually done in reality with. First one there, I've helped a tech company who scanned social media, things like Google, all those databases, huge databases of social media records out there, and turned that data set into a trading based tool that turned that data into simple technical analysis and signals. Another one, very strange one, this one, I've helped one of the UK's biggest fruit and veg farmers turning unconventional price data into a technical analysis tool that helped them to optimize when to buy and sell their produce for maximum profit. For example, in the UK there's 3 price points for fruit and veg prices. Very difficult to get hold of the information, but the government does publish this info. Downloaded it, turned it into technical analysis, and we could see exactly when the right time to buy and sell Brussels sprouts, strawberries, cucumbers were. It was all in there, and it helped them, like I said, to become more successful in their business. So it's not just about pure trading. You can actually use a systematic trading approach to even help your business. So as you can see, you can now marry together different forms of data and turn it into technical analysis. It's really never been easier to get your hands on and analyze models, big data, create models around big data. When I first started 30 years ago, everything was done by hand. This was impossible to do. And what are we looking for? Anomalies, patterns, behaviors over large data sets, and that could be economic data, company results, weather, inventories, storage, volatility. There's so many options for you available out there that you can turn into a systematic trading system. And as it says there, data plus edge plus TA equals a highly effective strategy around a point of view. So we've got the right mindset, we've got an idea, and we now have to turn that idea into reality. We've got to spec it out into the initial mental model, and we're going to focus on a more, like I said, technical analysis approach here. And it really is time to get into the nitty-gritty of building this systematic approach. So step 3 is all about planning the trading system. Spend decent time doing this bit right. Don't get carried away, don't rush into it. Get this bit right now, and it'll pay huge dividends later. So what sort of questions should you be starting to think about? Data. Are you going to need real-time or historical data? And is that data going to cost? How are you going to store it, access it, maintain it? How available is it to you? How are you going to make it secure? A lot of importance there around data, and it is more available now. You can be clever and maybe even go to your broker and get data feeds from there. I've used a system where I've piped into broker price feeds. There's lots of affordable data out there. Dig around, do your research before getting started, because it might kill off your idea straight away. What about the development? Are you building your own coded system? What's the best language to use? I like to use Python, by the way. And you also know, is your coding good enough? This is quite a tricky bit of work, and sometimes I've seen coders put in code that makes things look absolutely fabulous, but in reality is totally unrealistic. How are you going to test this? How are you going to prove that your coding works? Can it patch into a price feed? Can it execute the trades? There's a lot to think about and test when you're building out such a fully automated system. The flip side of all that is, if you're not a coder, programmer, you might want to use existing software, something like MT4, something off the shelf. Is it reliable? Is it too expensive? There's no point paying a fortune for it if the returns or the pot trading fund size that you've got isn't going to, outperform your costs. Development. If what are you going to do with this system? Are you thinking of selling it on? Are you going to create signals off it? Is it fully automated, semi-automated? What software, hardware is involved? And is the system strategy scalable? Can you add other markets? Can you go bigger in size? Are there restrictions around your broker? Also, what are you building this for? Is it to get a job, to trade just for your own, bit of a hobby, or something serious as a business? Now, as the strategy goes, we've got to define that life cycle. We're going to now break this down into 4 subsections, 4 parts, 4 steps: strategy, technical analysis, classification, quantification, back testing, and strategy system robustness. Now, the future, very important. You've got to think of the bigger picture here, outlining with rules the system going forward. It's the what ifs, the optimization, the development. You must future-proof your edge. I've seen so many systems that might be good for a couple of weeks and a couple of months and then die a death. You've got to be constantly working on improving and future-proofing your edge. Now, you've got to this part of the video and you're thinking, blimey, this is just too much for me. Don't panic. It's a lot easier than what you think. Building, designing a trading system doesn't have to be that difficult. It just requires basic set of skills, a business-like approach, a dose of common sense and some smart thinking. Like I said, it's easier than what you think. You've got to be committed, thorough, consistent, those key skills, the disciplines that go with trading anyway. If you've got those under your belt, you can learn this stuff and, like I said, build out the systems that you want to. So let's dive into that 4 sub-part steps that I talked about earlier: strategy, TA classification, quantification, back testing, and strategy system robustness. What do I mean by strategy, TA classification? Well, it's really defining where your strategy sits, and there's some very common buckets of strategies, as you can see there: mean reversion, statistical arbitrage, momentum, trend following, pattern, market making, sentiment. I'm going to show you a few examples in a moment, but where does your strategy fit within those buckets? Now, mean reversion, got an example here, SPY, QQQ, 2 indexes, ETFs in the States representing the S&P 500 and NASDAQ 100. I've tried to visualize it here for you in TradingView charts. It wouldn't actually look like this or be like this, but it sort of gives you an idea. You can see the Bollinger Bands I've placed around the spread between the two here, the S&P and the NASDAQ. When it reaches the highs, we sell the S&P and buy the NASDAQ, and vice versa. We buy the S&P and sell the QQ because we expect them to mean revert once they reach a certain extreme point within those bands. Here's another very popular strategy out there. It's the WTI Brent spread. Again, the same concept, mean reverting. When it reaches certain extremes that you measured by, you've tested, you sell the WTI, buy the Brent at the top there, and buy the WTI, sell the Brent at the bottom. Exactly the same idea, looking for mean reversion in that spread. And here's another idea on the VIX. That's the volatility measure of the S&P 500. Something for you guys that maybe want to sell options. When it reaches extremes, as you can see there, is a great time to sell S&P 500 options. Just another idea for you to think about. So here's another idea around momentum, another bucket in that list. It's just simply, if you're trading US stocks, it's the gap and go. This one's on Netflix, so you can see there's a gap and the trend, continues, the momentum continues on upwards. You can use various technical analysis indicators to measure that and, create a formulaic approach, a systematic approach to trading momentum. And here's a lovely, very obvious trend following example using my favorite Renko charts. New York cocoa, as we know, has been exploding in 2024, and putting together a combination of indicators, tools in technical analysis to provide you that edge, that timing in to follow longer term trends. So here's a possible system strategy idea around sentiment. The sentiment here is around the VIX, and that's really essentially the opinion of a bunch of options traders inputting the volatility into the VIX. So it's a sentiment gauge. You add that into price data, and you may or may not know that the VIX has a very inverse correlation relationship to the S&P 500. So we need to measure that, which is that blue line at the bottom. We apply some technical indicators, and as you can see visually, as the VIX goes up, the price of the S&P goes down, and vice versa. So how could we turn that last strategy idea into a set of systematic trading rules? Well, this is just for idea purposes only. Long only trade, you're looking for a correlation maybe of less than negative 0.3 because it's inverse relationship. The VIX price entering maybe Bollinger Bands down into the band equals a buy. We could do the flip trade if we want to go short, and then we're using indicators like DMI crosses and conditions met there, and we get out on the DMI cross. We're going to define our time frames as well, because from my experience this strategy works multiple time frames. You might want to test it out. Do you want to trade longer term using a daily chart? Maybe you want to get into more faster trades. What's the impact? What results do you get when you switch the time frames? Does it come worse, better than maybe trading long term? What risk could you allocate to it? Explore the time frames. That's that smart thinking outside the box part I was talking about. This time an example, marrying up sentiment, fundamentals and technical analysis. It's all around the Australian dollar. It's seasonality in play here, which is that table you can see there from the United States Department of Agriculture, USDA, and it's based around, like I say, harvest season and Chinese demand. So we can visualize this trade through the charts, and it really only happens twice a year. So this is what you also got to factor into your trading approach plan. How many times you want to trade in a year. This one can sit in the portfolio for 2 times a year. It's round about November and May time, and as we can see on the chart there, I've overlaid seasonality at the top. You can see those 2 points when it's time to get into the trade. And why do we know that? We've got the fundamental data, the sentiment data, and the charts to help us with our entry, exit and strategy. Well, don't believe me, here's a table of the results. Last 15 years, the April trades won about 93% of the time with simple time day entry, 6th of April to 14th of April. Yes, it can be improved. We can use technical analysis to seriously improve the results and make it more consistent. But like I said, remember, this is only 2 times a year trade. It's not something we could live off if we wanted to make this our full-time job. It's a nice one to have there in the portfolio. So breaking our trade idea down a bit further, we're going to be using, like I said, the Australian dollar against the US dollar, but why not consider against other markets, like the Japanese yen, Swiss franc, Canadian dollar, the pound. You could maybe use a currency strength tool to determine the best strength of combination of currency pair to put together to give you the optimal result, rather than just relying on Australia US dollar. Test it. That's what building systematic trading systems is all about. Now, I use the Renko Donchian setup, which you can see in the bottom left. On its own just gives me about a 60% win rate, but if I add it with the factor of the sentiment and the fundamental analysis, it takes me up to 96% win rate. And there's a back test there on the right hand side of the left hand 60% win rate chart, just to give you an idea of how I look at starting to piece together whether something works. Is that P&L return curve smooth or not? Is there too much of a drawdown, etc., etc.? Stuff we'll talk about shortly. Now, this one I really do like to use as an illustrative example. It's lean hogs in the States, pigs basically, used massively for the barbecue season seasonality play in there. If we weren't lean hog farmers, we would never be able to see this or know this, and we can visualize it through technical analysis. You can see there on the chart the seasonality, that blue line there, how it peaks and troughs. There's a huge sell-off when barbecue season ends around July, August time, 30-40% in the price sometimes, and we can measure that through technical analysis. It's all about, like I say, seasonality and market behaviour, and we can create a structure around it. Again, it's only a once a year play, but we can build up all these, our Australian dollar, our lean hogs all together, and we start to build up a really nice portfolio. So we've classified our idea as part of the mental model process. We now move on to quantification. What does that mean? Well, it's developing a logical framework with easily identifiable walkthrough steps, and every one of those steps has to be measured, to death, really quantified. You've got to produce hard evidence, hard statistical results that you have that edge. And how could you do that? Well, maybe like we talked about, that example being a coder, writing the program code to work perfectly. You could quantify it through that sort of process. If you can't do that, how could you do it? How could you ever measure the success, failings, optimization, the performance of your strategy? Well, it all comes in this quantification process, and one of the most important steps, that is of backtesting. We're just going to step back from the idea of backtesting to give you another top tip here. I like to use game theory in my trading. I'm not going to get too much into game theory here. I'll probably do another video on that. If you want me to do that, let me know in the comments. But it does help me focus. It makes me more systematic, disciplined, helps with the psychology. It's a very deep subject, but it really does help you start to think about the performance of your strategy. There it says edge plus risk management plus trading history equals game theory, basically. We've got some examples there, and this sort of touches on the idea of backtesting. If you haven't got the coding skills, where do you start? So everything's really a 50-50 chance game, and that's where we bring in the idea of game theory. So start from 50-50 and build up your data set of history. Maybe you have to do it in live trading, but in a much smaller amount to produce some results. Maybe you have to hand backtest through charts. Maybe use concepts like risk of ruin, Kelly criterion, expectancy, to produce those statistics that once you've got them, you can see whether you've got a trading edge. But they also massively help, like I said, the psychology, the emotions, and your overall approach to trading. So we've laid out a quantifiable, measurable structure for our trading systematic approach. We now move into testing the trading system. That's where we get more into the back testing side of things. What does back testing basically mean? Well, it's a process of confirming our mental model, our idea, our hypothesis. We're basically trying to prove whether our strategy works historically. So there's a lot of questions you need to ask yourself around back testing. What is the right time period to test? Is data 10 years ago relevant to today? Can I get away with just using it over 1 day of data? Probably not. But these are the sort of this is an extreme example, but I'm just trying to give you ideas of the thought process that you need to start getting into. Do you capture the events you want to in that back test? Is the right data in there as well? There's no actual right answer to this. There's no magic button for back testing. It comes down to skill, experience, smart thinking, all those variables for you to produce, and that's why there's so many different results in these types of systems. And also remember, even if you are a skilled programmer and you think you can code your way to billionaire trader status, please do remember that old GIGO, garbage in, garbage out. If your coding is no good, you're only going to get bad results. And it's the same for all the data analysis as well. So here's just a very quick visual on backtest I produced on a certain market. You can see the black line there, that's the P&L line looking very stable. The red line, red sort of chart there, I overlaid it, that's the drawdown. So as a minimum you want to start producing the profit and loss curve, call it equity curve, and a drawdown sort of results for your backtest, and that's where you can get started from, and then you get into a whole world of other statistics. And before you even get into those statistics, you can easily visualize through the P&L equity curve whether your idea looks good or not, and then you move it on from there. If it's no good, you bin it, go back to the drawing board. If it looks good, progress. And if I was to give a tip on the stats that you would really want to take away with you, to start with, the most important ones in my opinion: Sharpe, risk return and win ratio. You can start from there, and you can use that for so many things like Kelly's, all sorts of different things. If you were looking for a job in a top hedge fund, you're looking for a Sharpe ratio greater than 2.5 and above, you would be a very good trader if you could achieve that. But there's a lot of statistics that you can use, metrics, like we said, drawdown, risk return, expectancy, risk of ruin, Sharpe ratio, time periods, holding periods, so many different types of stats you can use. But learn them, get into them, become friendly with them, record them, because they are going to seriously help your trading in this systematic approach. And for example, here is just a selection of data, statistics. I pulled this one from my MT5 platform just on some random test I was producing, and you can see the sort of types of statistics you can use to create the optimal analysis to know whether things are working or not. So just looking around that page in the top left there, we got things like history, quality, number of bars you've used, net total profits and losses, recovery factors, total number of trades, etc, etc. Then we've got information like drawdown, correlations, the Sharpe ratio, expected payoffs, amount of short trades, long trades won, profit per trade, consecutive wins, losses, a whole load of information, Z-score, margin levels, your sport for choice there really. But don't get overwhelmed by it all. When you're laying out your framework, list what statistics, information you're going to use to try and prove your hypothesis. And what I like to do is, as you can see there, graph it as well. Do simple things like profit per day, by hour, by time zone, all those type of things. If it's visual and it helps you, use it, put it together. But like I said, make this approach also to testing very systematic. So a few further tips around backtesting or considerations. Data, very important. Lots of sources these days. We've mentioned it before, but the lower the time frame you're going to go to, the more likely the costs are going to mount up. There are free sources out there, stuff like Yahoo Finance, or more sophisticated like Alpaca or Polygon. Probably going to cost you some money, so factor that into your business plan, systematic trading plan as well. Or like I mentioned also, I've used a broker like IG Index over here in the UK that allow you to run APIs into their data because you're a customer and pull back live real-time data for nothing. So there's lots of options, but make sure you get them right. And what if you are a coder? What tools are there out for you to do backtesting? Well, if you're into Python, something like backtesting.py or Vector BT are good bits of kit to help you with your backtesting that you could add into your Python building. I'm going to also say this again because I see it time and time again. If you're a coder, make sure your results don't display bias because of how you've coded. They may be better than what you think they are. Always double check. Very easy to make mistakes, which could be very, very costly. And if you're not coder, what could you use? Well, MetaTrader, MT4, MT5 have got some real good backtesting functionality in there, worth having a go. And if you use TradingView charts, you could maybe teach yourself PineScript language, which is quite straightforward as well. Easily accessible to create your own backtests through strategies built using the charts there, or quite simply, as I often do, get open the old Excel spreadsheet and put the data into there and manipulate it around that spreadsheet. Now let's quickly look at an example in TradingView to give you some sort of idea of reality. We've got an example here, Bitcoin, using the Ichimoku Cloud and RSI. So here's the rules. Doesn't matter whether it's long or short. Orders are placed when 3 basic signals are triggered on the 5-minute Bitcoin chart. Long position, reverse a short position. Tenkan Sen is above the Kijun Sen. Chico span is above the close of the 26 bars ago. Closes above the Kumo Cloud. RSI is less than 50 and a trading fee of 0.1% is taken into account. So what does that look like? So here that is in TradingView. Remember I mentioned the Pine script language that they use. Now on the top we've got the chart, the Bitcoin 5-minute chart with the variables that we were looking at. We've got the Ichimoku and the RSI. The RSI is not visualized on there at the moment. And below that, the important bit to this is the back test. Now if I just make that a lot bigger, you're looking at that and going, wow, that looks absolutely rubbish. But remember I mentioned smart thinking. We've got an equity line that goes rocking all the way down like that. Why don't we do the reverse of the trade? Simple as that. That could be your edge, your idea. You've tested a strategy, it's gone completely wrong, the reverse. Why not do the reverse? And just to give you an idea of what you got in there in TradingView, it gives you your stats already built in for you to help you guide you into whether your strategy is good or not. You've got an edge. It's listed the trades for you as well, the properties of it. And like I said, in there graphically, you can play around, you can add things to the strategies to make better results. Or like I said, you might be content with that being a reverse of your idea. So just a, visualization there for you when you start to get into the world of backtesting. So just to reiterate, getting statistical results, very important. You are going to need some skills around how to interpret them. Obviously critical. If you can interpret well, then you're going to produce good results. It's not just about interpreting, it's what you do with them also after that. And like I said, just getting 3 simple ratios after producing the equity curve, the win-loss ratio, risk-return ratio, Sharpe ratio, going to help you massively, and that optimization process. Now we just mentioned the optimization process. This is about getting your idea as optimal as possible and also making it as robust as possible. Now again, this is also often overlooked. There seems to be many parts of the jigsaw that are the puzzle that are often overlooked, and that's probably why most people fail. But this is another key part of the process. Are you using the most optimal parameters? It's all common sense really. Are you forward testing your strategy? Is it going to work going on into the future? You've looked in the past, but is it going to work into the future? How can you do that? I'm not going to get too heavily into this. Again, if you want me to, I can make videos on Monte Carlo simulation. But one of the tools you can use is Monte Carlo simulation. Now, this is getting very technical. So for those that aren't maybe as computer savvy or quantitative savvy, it's not essential, but I do say you've got to really start thinking about how you're going to measure your strategy and performance going forward. There are some manual hacks, some more physical stuff that you can do rather than going this say Monte Carlo heavy quantitative approach. Some simple stuff that would put the odds more on your side, but if you're doing it properly, Monte Carlo simulation really is a great tool. When you're putting together your Monte Carlo simulation process, build different factor models to randomize the input parameters as much as you can. For example, different market conditions, scenarios, technical analysis parameters and inputs. For example, what's the optimal parameters around moving averages? 50, 30, 20. But the key here, and a rule you really must adhere to, is do not backfit to just make this work and give you what looks like an edge, but when you come to reality and trade it, actually loses you money. Don't backfit whatsoever. So what I like to do is try my ideas over different markets, different time frames. You know, be honest with yourself. I suppose that's the most important takeaway of when you're doing this sort of testing. Be honest, because essentially you're only cheating yourself. Another thing you can do or should be doing is out of sample testing. What is that? Well, you've tested a trading idea and formed a conclusion, but you need to test your strategy on unknown data. So it's sort of like breaking down your back test into subparts, testing them individually to see whether they work, comparing them to the overall picture. And I've sort of tried to graphicalize that through that picture there, but a key process, it's out to sample. You're taking a sample of data, you're testing it. Does it work in that period? If it doesn't, why not? You know, drill in. It's always asking questions, trying to find results, trying to optimize, trying to improve your methodology process to give you that optimal, consistent edge. So let's just summarize it out of sample testing again, because it's one of those overlooked things. You think it's a bit complex, a bit unnecessary, but it's not. How do we do it? Well, we split the back test into relevant parts, analyze versus the different split parts. We're looking for validation in that process, confirming our hypothesis via the out of sample test. Did the sample predict the out of sample results well? If not, you should not go live with that strategy. We've got to do more work. Some tip there down the bottom for coders, something for that out of sample you want to use in Python. Vector BT, very good at that. Now this is an area of the process where you can really make your strategy effective, really put the pounds, the dollars in your pocket. And again, it's not very thought about in this strategy build. It's the optimization of the risk management and portfolio optimization process. Like I said there, it can make you even more dollars. It's about trade sizing, scaling size, time, compounding, stop losses, using trailing stops, signals only, using stuff like Kelly's, Kelly criterion to scale up winning home run strategies. All of this can be tested and optimized to improve your strategy, and I think you really got to consider this in your work. So some examples for you. You've got a multi-asset portfolio. For example, I like to trade lots of markets. If a trade has met the selection process, in my world, it then goes into the portfolio optimization bucket, which looks to size the trade to maximize returns while minimizing the risk. This is the portfolio risk trade sizing system. Works out an optimal trade size based on an amount you set as your preferred maximum loss, and it comes up to a suggested trade max loss risk size based off the performance of the back test of that instrument and in context to all the other instruments within the portfolio. What does that exactly look like then, and what does that mean? Well, let's take an example. For example, you've got 10,000 set as your max loss per trade. This type of process will match up the best portfolio performer and scale the others either up or down accordingly. So say the max loss was set at 5% on any one trade. So I use something called preference function, where one asset is weighed up versus the other. The probability of success, the risk appetite. The better trades in our example would be near the 10,000 level. The worst trades would move more towards zero. So let's look at that visually. Well, on the left we have the results, in terms of numbers, but I want to draw your attention to that chart there on the right, because this helps explain things a lot easier. On the x-axis we have our trade performance, on the y-axis our potential trade size, and you can see the better the performance, the bigger the trade size. And we simple bit of linear regression really. You can see the worst performers in the portfolio actually get the smallest risk per trade allocated to them. Makes sense really, doesn't it? So in a way you're optimizing your portfolio, your systematic trading process to get the optimal result. Right, we're now ready to go live. It's time to press that red button. We are going for it. We've done all the testing so far. We're confident in our approach. it's time to go live. But that doesn't stop the testing, analysis, commitment to improvement process that we've got as part of our mental model, our business plan. Now, when going live, I like to set what I call an incubation period, maybe 2 months or 3 months. Well, there's a couple of methods. You can run it for 3 months, call it on a demo account, or like I like to do is actually go live but with a small amount of money put towards a smaller trade size than what you were going to do for that period of, say, 3 months. So why live? Because you learn far quicker, I think, when you do it live than running demo. You're not as observant, you're not as on the ball. So I always like to go live for there. So we now need to commit a period of time, as like I say, the incubation period for our initial go live phase. We also need to forward test our results, the results we're getting versus what we've expected from our back test. And if they're not coming to fruition, why not? Has our edge eroded? Is there something we missed, like slippage maybe in trade execution? So we've got to plot actual versus tested for that period of time to again try and improve the process, find the problems, iron them out, so we've got the optimal setup when we really go live on full money. You could maybe even in this slide plot or simulate a forward range of returns and see where you are versus expectations. Are you overperforming, underperforming? What in terms of standard deviation moves are you away from that? And can track your performance. Are you improving? Are you ironing out those mistakes and problems and moving more towards the back test? So like I said, very important that you don't just go live for go live's sake. It's also a part of, like I say, the bigger picture. Just to give you an example of edge erosion and always being on top of your results, one of the jobs I worked for in a commodity company, we noticed trading around about 4 p.m. front running people, because we noticed through our analysis that a lot of people bought WTI crude oil on the Friday afternoon around about 4 o'clock. So if you can get in front of them, you can make some money. But if you went big, you would raise the red flag to everyone and your edge would surely erode very quickly. So sizing and timing, very important. Eventually that strategy did die out because more and more people noticed it. But in that period we ran it, we optimized it as much as we could to make as much as we could before it naturally died. And that's what you've got to also realize. Sometimes these strategies do just die out. They no longer have an edge, and your statistics are going to help you show that. And you've got to be brave and, like I said, honest with yourself. If it's dead, it's dead. You've got to move on, find something new. If you can breathe more life into it, earn some money out of it that's sufficient for your whatever you want to try and achieve, then keep it going. But always monitor what's going on. So another example from my own world, work with various US hedge funds, and we've got similar processes. I deal with them. I come up with ideas and I send them basic equity curve data over a period of 3 months. The hedge fund analyse it for an edge. Does it fit into their portfolio? Is it something new that they can use? If so, we then go through the incubation testing, and then hopefully we go live. Maybe your ideas are rejected there and you go back to the drawing board and you just keep firing ideas until it works. But it's just an example of that process that we've talked about. Idea, producing the equity curve, the hedge fund and yourself have done the analysis, on the live trading results in the incubation testing period, and then you can decide how to take it forward from there. I just want to summarize a few things now. Systematic trading is hard. 90% of traders lose. In ordinary discretionary systems all the way through to systematic trading, it's a tough job, but if you do it well and do it right, it can be very rewarding. Remember, psychologically, even if you aren't the best programmer, you will tinker, panic, make mistakes. I've seen it. for real on the live trading floor. You know, top brains, you know, maths, science, programming. You know, when the numbers don't start turning out right, they think there's something wrong with the program, change the rules, change the results. You can't do that. You've got to give your idea, your systematic process, strategy, the chance to work, and you've got to, like I say, set the rules out very clearly and stick to them as much as you can if you want to give your system the best chance of working. And essentially also, like I said, mentioned earlier, psychologically, you're going to use that data to manage your emotions. It's going to make you more objective, more quantifiable, which is what we're looking to achieve, and it's going to make your whole world a lot easier and more profitable and effective. So we're back to where we started, the 7-step process. Remember, first, get the right mindset and skills, then build that mental model with having the idea, planning, building, testing and optimizing the system. Then we get some results, we go live, we've got that incubation phase, and we measure, analyze, and we keep looping it round and looping it round until we've eked out enough of the edge as we possibly can from our strategy or system. So there you go. There's your roadmap to building a successful systematic trading system or strategy, that 7-step approach. Now is the time for you to go and do the work. You know, you've got the background to build on. Go away and start to do it. Now, if you like today's video, please give us the thumbs up. Don't forget to hit the subscribe and notification buttons to receive future content like this. Let me know in the comments below what you think of the video. What do you do around the world of systematic trading? Any thoughts, suggestions, always welcome. And if you're interested in my Renko trading and what I do there, I've got a playlist. You know, start from the top, work your way through to the bottom. Covers all you need to know how to become a master at the art of Renko chart trading. And here's that playlist coming up now.